Warren Buffett, the Oracle of Omaha, is a legendary investor. He's known for his common-sense approach to investing, focusing on value and long-term growth. Buffett's philosophy is simple. Invest in what you understand and hold on to those investments for the long haul. He looks for companies with strong fundamentals like consistent profits and good management. Buffett's success has made him one of the world's richest people and a respected voice in finance. His every word is scrutinized by investors worldwide. So, when Buffett speaks, people listen. And when he started expressing skepticism about cryptocurrencies, the financial world took note. His criticisms stem from his deep-rooted belief in traditional investment principles, which are fundamentally different from the world of digital currencies. Bitcoin, the most famous cryptocurrency, has experienced a meteoric rise. From its humble beginnings, it has captured the imagination of millions around the world. Created in 2009 by an unknown person or group of people using the name Satoshi Nakamoto, it was initially worth just a few cents. Back then, only a handful of tech enthusiasts and cryptography experts were aware of its existence. Fast forward to today, and Bitcoin has seen its value soar, reaching tens of thousands of dollars per coin at its peak. This incredible growth has turned early adopters into millionaires and even billionaires, sparking a global frenzy. This dramatic rise has attracted investors of all types, from seasoned professionals to everyday people looking to capitalize on the crypto craze. The promise of high returns has led to a surge in interest, with people from all walks of life jumping on the Bitcoin bandwagon. The decentralized nature of Bitcoin, operating outside the control of governments and central banks, has also added to its allure. This independence is seen by many as a way to escape traditional financial systems and gain more control over their own money. However, this rapid growth has also been accompanied by extreme volatility. Bitcoin's price can change dramatically in a matter of hours, driven by market speculation, regulatory news, and macroeconomic trends. Bitcoin's price is known to swing wildly, making it a risky investment for the faint of heart. While some have made fortunes, others have lost significant amounts of money in the blink of an eye. This inherent instability is one of the key reasons why Warren Buffett, one of the world's most renowned investors, remains wary of the cryptocurrency world. He is often referred to Bitcoin as rat poison squared, cautioning against its speculative nature. Despite the skepticism, Bitcoin continues to gain acceptance. More businesses are starting to accept it as a form of payment, and Bitcoin ATMs are popping up in cities around the globe. This growing adoption suggests that Bitcoin is becoming more integrated into the mainstream financial system. Yet Bitcoin is not without its controversies. The environmental impact of Bitcoin mining, which requires vast amounts of energy, has raised concerns. Critics argue that the carbon footprint of Bitcoin is unsustainable and poses a significant threat to the environment. Additionally, governments around the world are grappling with how to regulate Bitcoin. Some countries have embraced it, while others have imposed strict regulations or outright bans. The regulatory landscape remains uncertain, adding another layer of risk for investors. As Bitcoin continues to evolve, its future remains a topic of heated debate. Will it become the digital gold of the 21st century, or will it prove to be fool's gold? Only time will tell. What is certain is that Bitcoin has already left an indelible mark on the world of finance and technology. Buffett's criticisms of cryptocurrencies are rooted in his fundamental investment principles. He has always emphasized the importance of investing in assets that have intrinsic value and can generate cash flow over time. This philosophy has guided his investment decisions for decades, leading to his immense success. He argues that cryptocurrencies, unlike stocks or real estate, don't have intrinsic value. Stocks represent ownership in a company that produces goods or services, while real estate provides tangible property that can be used or rented out. These assets have a clear, measurable value based on their ability to generate income. Cryptocurrencies, on the other hand, don't produce anything tangible. Their value is solely derived from market speculation, which can be highly volatile and unpredictable. This speculative nature makes them a risky investment, as their prices can fluctuate wildly based on market sentiment rather than any underlying economic fundamentals. He compares Bitcoin to a mirage, suggesting that its perceived value is an illusion. Just as a mirage can appear real but is ultimately insubstantial, Bitcoin's value can seem significant, but lacks the concrete foundation that traditional investments have. This comparison highlights his belief that cryptocurrencies are not a reliable store of value. Buffett believes that investments should be based on tangible assets and the ability to generate future cash flow. He often points to businesses with strong fundamentals, such as consistent earnings and a competitive advantage, as ideal investment opportunities. These businesses can provide a steady stream of income and have the potential for long-term growth. Cryptocurrencies, in his view, fail to meet these criteria. They don't generate earnings, pay dividends, or have any inherent value beyond what people are willing to pay for them. This lack of intrinsic value makes them speculative and, in Buffett's eyes, a poor investment choice. He has even famously compared Bitcoin to a button, emphasizing that it lacks any real-world utility beyond its potential as a medium of exchange. While a button has a clear practical use, Bitcoin's utility is limited to being a digital currency, which he argues is not enough to justify its high valuation. This skepticism has made him a vocal critic of the cryptocurrency frenzy, cautioning investors about the potential for significant losses. He warns that the hype surrounding cryptocurrencies can lead to irrational exuberance, where investors pour money into these assets without fully understanding the risks involved. By highlighting the speculative nature and lack of intrinsic value, Buffett aims to steer investors towards more stable and reliable investment opportunities. Section 4. Crypto's Wild Ride, Volatility, and the Fear Factor. Cryptocurrencies have taken the financial world by storm, but with this excitement comes a significant amount of risk and uncertainty. One of Buffett's biggest concerns about cryptocurrencies is their extreme volatility. He has often voiced his skepticism, pointing out that the unpredictable nature of these digital assets makes them a risky bet. Unlike traditional assets like stocks or bonds, which tend to fluctuate within a certain range, Bitcoin and other cryptocurrencies are known for their wild price swings. These swings can be influenced by a variety of factors, including market sentiment, regulatory news, and technological advancements. This volatility makes it difficult to value cryptocurrencies accurately and poses significant risks for investors. The emotional roller coaster that comes with these price changes can lead to hasty decisions, often resulting in substantial financial losses. A sudden drop in price can wipe out a significant portion of an investor's portfolio. For instance, a 20% drop in Bitcoin's value in a single day is not uncommon, and such drastic changes can be devastating for those heavily invested. This inherent instability is at odds with Buffett's investment philosophy of seeking long-term stable growth. He prefers investments that offer predictable returns and have a proven track record of performance over time. He argues that this volatility makes cryptocurrencies unsuitable for long-term investments and more akin to gambling than investing. Buffett has often compared investing in cryptocurrencies to betting in a casino, where the odds are stacked against the player. This cautious stance has resonated with many traditional investors who share Buffett's aversion to excessive risk. They prefer to invest in assets that offer more stability and predictability, even if the potential returns are lower. Despite the allure of high returns, the fear factor associated with cryptocurrency volatility cannot be ignored. Financial analysts often caution new investors to thoroughly research and understand the risks before diving into the crypto market. Education and awareness are crucial in navigating the volatile world of cryptocurrencies. By understanding the underlying technology and market dynamics, investors can make more informed decisions and potentially mitigate some of the risks involved. The younger generation, in particular, has shown a keen interest in cryptocurrencies, driven by the potential for high returns and the allure of being part of a financial revolution. However, they must balance this enthusiasm with a healthy respect for the risks involved. In conclusion, while the volatility of cryptocurrencies presents significant opportunities, it also brings substantial risks. Warren Buffett's cautious approach serves as a reminder that not all that glitters is gold, and careful consideration is essential when navigating the crypto landscape. Section 5. Bricks versus bytes, comparing apples and, Bitcoins. To understand Buffett's skepticism, it's crucial to compare traditional investments with cryptocurrencies. Traditional investments, like stocks, represent ownership in a company. These companies generate profits, pay dividends, and have tangible assets. Real estate, another favored investment by Buffett, provides income and appreciates in value over time. Cryptocurrencies, on the other hand, are purely digital assets. Their value is derived solely from market demand and speculation. They don't generate cash flow, pay dividends, or represent ownership in any tangible asset. This fundamental difference in nature is at the heart of Buffett's critique. He views cryptocurrencies as speculative bets, while traditional investments are grounded in tangible value and potential for future income. Stay savvy and subscribe.